Okay, so let us go ahead and take on this example on price to book value ratio. It is an example from the chapter corporate valuation. And the minute people see the question, they might say that, sir, we have seen this in the previous video. But I'm going to solve the same example another way. Now, where you can calculate the book value per share using the return on equity formula and also calculate the price per share using the Gordon's dividend growth model. And then you can calculate the price to book value ratio. So in case you guys have the time, then you can also go through this video. And so let's go ahead and take on the question once again. And then we shall take the solution, but worked out in another way. Yes, Subhash, read the question for us.
ABC Limited had earnings per share of rupees 11.04 in 11.04 in 2010.
In the year 2010 that has gone by, say the current year, your company earned, that is ABC company earned rupees 11.04. That is supposed to be the earnings per share. Yes, sir.
And paid out a dividend of rupees 6 per share.
So rupees 6 is supposed to be the D0, dividend for the current year. Next.
The growth rate in earnings and dividends in the long term is expected to be 6%.
It is given that as the earnings grow by 6%, you will also grow the dividends by how much? 6%. You will pay 6% more. Yes. That is a growth rate in earnings and dividends. Next.
The return on equity at ABC Limited is expected to be 14%.
You saw that is supposed to be the return on equity. Expected means what? We all know the formula for return on equity, where you take the earnings, the numerator, divided by the equity funds. You can either take in toto, the total earnings available to shareholders, divided by the total amount of equity funds. That is share capital plus reserves and surplus. Or you can take the expected earnings, that is earnings per share, divided by book value per share. Please remember, book value per share is nothing but the amount of equity, share capital plus reserves and surplus on a per share basis. Is that fine? But remember, it's a return on equity. Expected means what? It is a return on equity equals expected earnings, not the current earnings, divided by the book value, the equity funds employed as of today. Like, like a D1 by P0, this is what? It is expected earnings E1 divided by book value not at time 0 today. Is that fine? Next.
The beta for ABC Limited is 0.8.
The minute they give the beta, you should know you're going to use a CAPM formula somewhere. Next.
The risk-free rate is 6% and the market risk premium is 4%.
And remember, in this case, the risk-free rate is also 6%. Same as the growth rate, right? Don't get confused. And what is the MRP, the market risk premium, which is supposed to be the RM minus RF, which is 4%. Next.
Based on the information, find out the price to book value ratio of ABC Limited.
Now, that is a question, okay, put to you. So, this can be an MCQ. Now, let us go ahead and take on the solution. But here, there's another way to work out this example. I'm going to explain this. Now, first, I'll write down the formula for return on equity, which is equal to expected earnings. That is earnings per share expected divided by book value per share. Now, people are asking, what about into 100? So, I'm just ignoring into 100. I'm going to express the return on equity as, decimal format, 14 by 100, 0.14. Say 14 by 100 equals, we know the current earnings are 11.04 rupees. that into 1.06. Nothing but 1 plus the growth rate. This 0.06 is 6% growth in earnings. So 11.04 into 1.06. And then you divide that by book value per share, we don't know, which you can calculate. It's a simple math, right? No brainer. Therefore, I can say the book value per share equals, it is 11.04 into 1.06. How much you get?
11.7024.
Very good. That into 100 by 40 will give you the book value per share as rupees 83 point blah blah. Right? How much? 83 point?
59.
Okay, 59. Now, then next step will be, let's find the CAPM cost of equity. So the CAPM is capital asset pricing model return equals, I can take RF as 6% given plus the beta 0.8 and that into the market risk premium, which is 4%. So 0.8 into 4 is 3.2 in percentage. Add a 6 to it RF, you get 9.2% as a cost of equity. This is the second step. Now the next step what I do is, I can go ahead and use Gordon's formula to find the P naught. Now this is written in two steps. We know cost of equity equals D1 by P naught plus G, or I can say P naught is equal to, what is P naught? It's supposed to be the current price of a share, the market price, which is equal to D1 expected dividends divided by cost of equity minus growth rate. It's a very popular equation. You all know this, and you should know this by now, right? Your examination is knocking on your door, waiting for you to open. It is D1 will be how much? 6 rupees into 1.06. How much you get? It is 6.36 the numerator, 6 rupees and 36 paise expected dividends. The D naught is 6 rupees, that into 1.06, that is growth rate 6%, divided by 0.092 minus 0.06. Now when I divide 6.36 by 0.032, I get rupees 198.75. That is supposed to be the current price of this particular share. Now we come to the last step. What is that? Price to book value. Now we know the price per share is 198.75. We also know the book value is rupees 83.59. So please divide 198.75 as a price, numerator. Denominator, the book value per share, rupees 83.59. So how much you get? You get 2.38. And you all know that all these multiples, whether it's a price to book value, price to earnings, or price to sales, we express them in what? Times. So 2.38 times. And that is supposed to be the price to book value ratio. It is the same answer you would have got. Okay, you would have seen that in the previous video. In case you haven't seen that, go watch that, and also this for better clarity. Is that clear? Okay guys, good luck for examination. Bye-bye.